fellows, this is Vinney Chopra live from Apartment Syndication Made Easy. As you know, the podcast, the book I wrote, and now it's also in Spanish. Oh my gosh, my other book is coming out, Positivity Brings Profitability. Then my third book, Investing in Senior Assisted Living, all that. So look forward to, bringing out to you all. And you probably see me on Instagram, on YouTube, on Google, and everywhere. Again, this is Vinney Chopra. I live near San Francisco in Danville, Blackhawk, and I try to bring every week a new episode of some industry specialists. And I'm really, really glad that I have my good friend Kyle today. Kyle Schielack right there. Right, Schielack, right? How do you pronounce?
Sir. Schielack, but it's pronounced so many different ways. Right. It's all good.
Kyle and Schielack from Houston. He's been helping me to look at my portfolio for quite a few years. And he's a commercial insurance brokerage business. And let me introduce Kyle. Thank you for joining, buddy. Thank you so much.
Inviting me, Vinney.
Yeah, it's such a pleasure to have you. Let me kind of introduce you formally so that we can go dig into your, the whole business of commercial insurance, which is a very, very important part of the business in getting multifamily, commercial, everything that we do. So let me talk about Kyle. Kyle joined Higginbotham is his company, and the best in Texas as a vice president and shareholder for business insurance. Fall of 2016. He has since been named as executive vice president and practice leader for the real estate. Congratulations, Kyle. That's awesome, bud. And he started his insurance and risk management career at Marsh and McLennan agency in the Houston area, Texas, in summer of 2009. So you know the ins and outs. And Kyle holds a Bachelor of Business Administration in Finance from Mays Business School at Texas A&M. That's in San Marcos, right? Is it?
College Station.
College Station, that's right. And Kyle specializes in risk management for multifamily portfolios. He's done a great job for my portfolio, and we'll talk about that. Property management portfolios, retail, industrial, office space, all kind of commercial property developments, manufacturing, wholesale, distribution, professional. Great experiences. I love that. Kyle is also heavily involved in the community in many great organizations and charities. And Kyle and his wife, Allie, and daughters are active members of their church. In his spare time, Kyle enjoys hunting, traveling, golfing, and spending time with the family. Welcome to the show, Kyle. I'm really proud to have you, bud. And
thank you.
Yeah, we're going to have fun. So tell me more. So you grew up in Texas, in Houston area, or how?
Actually, I grew up in a really small town in central Texas. Town is Rockdale, Texas. Actually was known and put on the map because of Alcoa. That's since shut down after about 60, 70 years. But after Texas A&M, have been in Houston and been a Houstonian ever since. My family has kind of migrated to Houston, and so, we've been Gulf Coast for the better part of a decade and a half now. So Houston is home for us.
Awesome. How I know your degree was in, I was just looking at it again, at Texas A&M business, right? Business degree. So how did you really get linked up with insurance? What got you?
Great question. Great question. We always joke about it in the insurance world. No one grows up saying that they wanted to be an insurance broker. Honestly, I had a great desire to be in the commercial banking space. My brother, my mother, they had all gone through the commercial lending. So I actually joined a large bank in Texas, Amity Bank, right out of college. But quickly realized that my passion was in the risk management phase. So I actually went to work for one of the bank clients, which was a large insurance broker in Houston area that eventually was acquired by Marsh. And so that's how I fell into insurance and then just fell in love with it. So
awesome. And it's so much needed. Oh my gosh. Nothing in USA and anywhere in the world we should possess or put it or buy without insurance. Even ourselves, life insurance, Keyman's insurance, all kind of insurances. It's so important. It's something that we feel that it's a cost, but it should not be considered as a cost. It's an investment for sleeping good at night and everything. And from the lender perspective, of course, they won't never give us a loan unless we get full insurance, you know. So kind of share with us in your commercial field, what kind of insurances maybe to our audience, then we can dig into a few of them and look at the whole spectrum. Yeah.
Okay. So on the commercial insurance side, there is many different policies that you can kind of get involved with. I'll stay more geared toward the real estate sector. The property policy is always, it's the main lender requirement. I mean, they always want to make sure the asset is covered. So we can dive into that a little bit later. Are you covering it for the asset? Are you covering it for the lender? So obviously the property policy is extraordinarily important. Included in that, you have boiler machinery coverage that's built in. We get into general liability, which is third-party lawsuits for bodily injury and property damage. Of course, very, very important for every business, including real estate, to have. Of course, you have limited auto exposure, but we can dive a little bit into that. Even if you don't own an auto, you still have folks that drive on behalf of your businesses and or real estate entities, and will most likely always be brought in on a lawsuit with regard to any form of accident to a third party. So you have auto. Workers' compensation, which in many states is required. In Texas, it's voluntary.
Yep.
And then, of course, excess liability that sits on top of all of your liability policies. So that's what I tend to focus on the majority of the time. But outside of the real estate sector, I think the big topic right now is the business interruption. You know, businesses not getting their rents in, businesses not getting their revenues in because of COVID-19 shutdowns. Yeah. And when we get into the industry hot topics, that's when I'll really like to dive into and kind of what the response is from the industry.
Beautiful, beautiful. And again, you know, you might also talk about, like, we are vertically integrated. You know, we've been managing all our assets, directors insurance and top management insurance, key man's insurance, which is kind of different. It's a life insurance thing. But, you know, how about the cyber? I know you and I worked on cyber insurance. I got hit by that. So that's another.
Absolutely.
Yeah.
Actually, yeah. And before I jump into cyber, to go back, directors and officers, I love that you bring up directors and officers. I think that is one of the most under discussed, if you will, policies. And I think it's just the idea that public entities are the only ones that need or are required to have directors and officers. But I will tell you, vast majority of claims are private companies that get sued for decisions that directors and officers make. Yeah. And so that protects the personal individual and all of their assets, including the business, as they're sued as well. So I think that was a great point to bring that out. Management lines, I think, is also a great topic. We're dealing specifically with employment practices, which is just fancy term for sexual harassment, wrongful termination, discrimination, both first and third party. And then, of course, we get into the cyber topic, which is, I would say, the better part of the last 10 years. It's been hot. You know, Target's been hit, Sony's been hit, and these are massive claims. I will say that the most often, you know, claim that's filed from a cyber liability standpoint really has nothing to do with malware, hardware, software, or anything of that sort. It has to do with what they tag social engineering, which is just fool me. You fooled me. You didn't hack into any system, but somehow, some way, you were able to steal money from me. A lot of folks like to look back at the old email they used to get. You know, I'm a such and such, and I'm across the world, and I need to get out of here. Please send me money. Yeah. That was the old way. Today, these guys are so much more detailed. They will watch. You know, the attackers will watch for about call it a year, 18 months before they ever perform a social engineering attack. So we can always dive into cyber, but I just want to point that out, that cyber is a very hot topic, and it's fascinating to see how cyber that was never spoken about in the 90s and the early 2000s is now probably the hottest topic in the industry. So.
It really is, you know, and like, I think I've read, and it happened to us also, where, you know, these attackers, they find a website with a little slip of one alphabet, and it looks like it's yours and so forth, and they get copy your email and all that address, picture, everything, then they can send
That's
out
exactly right.
hacking into, I think I know they said about mail system, they hack in, and then they hack in the wiring. That's the other big fraud, is when the syndicators like me, we are very particular now. We never email anything at all, to our investors. We securely send them or call them and give them the routing number and the account number, rather than putting it in the email, and they look for that wiring, the subject lines, I guess is the word. But no, let's get into the nitty gritty of the property insurance. So, and of course the hurricane insurance, and oh my gosh, all kind of. So tell us more about it, and how do we go about getting the best insurance for the property so that investors are well taken care of. It may cost a little bit money, but it's well protected. Yeah.
Great. Okay. So before I dive into the individuals, I'll start by kind of giving the highlights of how the industry is reacting as a whole. Specifically, it's reacting heavily on the real estate marketplace. From a property standpoint, whether you're in the Gulf Coast or not, Hurricane Harvey, Irma, Maria, Michael had direct impacts on the entire marketplace. The California wildfires, the current Arizona wildfires, the same insurance carriers are being affected. So this is it's a very catastrophic past 4 or 5 years. And so when you have extreme catastrophic losses like these, and the insurance companies reporting massive losses on, for their investors and their shareholders, of course, there is a hardening of market, and that's just fancy term for the rates have gone from low to high. And I will say, out of a 10-year span, just to give investors and buyers an idea, out of a 10-year span, we say a hard market is about 2 years, while soft market lasts about 8 years. So it'll be trending downward. There'll be some catastrophic events that will shoot it hard for a couple of years, and once profitability has stabilized, then you'll see the softening of the marketplace as well. Now, that's just hypothetical, but just looking back on the past 2 decades, we've had just a few hard markets, and we are experiencing a very hard market on the property right now. It started roughly 18 months ago, and we expect it to last probably for another 6 months to 12 months, barring no major catastrophe.
Wow.
I will say that things are finally seeming to soften up a little bit, in that they're stabilizing rates instead of continuously increasing rates. So we are seeing some positive feedbacks, but to dive into the property, I will be looking here at my screen for a second, just to make sure that I don't miss out on any major key points here. When we're dealing with property, the first thing you want to deal with is making sure your replacement cost is in sync. Always go to the covenants of your loan. That's the basic minimum. You never want to have any less than what your loan replacement cost is requiring. Little sidebar, many lenders, and they don't like me to point this out, but many lenders like to include land in the acquisition as far as being covered in real estate.
Wow.
That's not legal. You can't insure property. Insurance companies won't insure land. So at the end of the day, it's always best to know what the appraisal shows is the true replacement cost. That is what your loan covenant should state as the true limit of coverage you're buying. To dive in, typically you have a multi-line deductible structure. The first one I like to always say is AOP. That stands for all other perils. That's essentially all other perils from wind and hail. So that's your fire, lightning, smoke, vandalism, glass breakage, water leakage. All of that falls under all other perils. I'll say the industry standard was 5,000 to 10,000 10 years ago. Today, 10,000 and 25,000 on the deductible per occurrence is pretty standard. So that's what you'd be looking at that. Diving into the wind, while it used to be, call it a flat $50,000 or $100,000 wind hail deductible, the industry, through this hardening of market, has gone back to percentage deductibles for wind and hail. While when you used to be able to get 1% and 2%, most carriers are offering only 2%, 3%, and 5% now as far as named windstorm deductibles. So something to keep in mind when you are trying to save cost in a rising market like this. The named storm deductible and the all other perils deductible are two key ingredients that you can take on some of that exposure and offlift some of that premium that you'd be paying as far as what's going on in the marketplace right now. Just a few other points I want to point out before I go off of the property. Something that a lot of brokers miss out on is something called ordinance or law. Many lenders will require this, but some don't. Ordinance or law is just basically therefore you are now required by the city ordinance for a change after a loss, and it wasn't there before. The great example I like to give is sprinkler systems. If you have a 1960s, 1970s, 1980s facility, and it burns 60% to the ground, well, the city now may require you have to replace the undamaged portion of the building, you have to remove all the debris, and you have to include all of these new city ordinance, sprinklers, ACA compliance, all of these things that wasn't there before. And insurance is only there to bring you whole. It doesn't provide you coverage of something that wasn't there before unless you have ordinance or law. So always make sure you point out with your broker to discuss ordinance or law and the true importance of that. Lastly, I wanted to point out business interruption. So for general business, that's loss of revenue. So when a business were to shut down, call it for 3 months, they would claim business interruption for 3 months of lost revenue. For real estate, I like to change the business interruption term to loss of rent because that's what it is. So I wanted to point that out. Now, one big caveat, because we are in the season of COVID-19, I will say that a very large percentage of the marketplace, and by marketplace, I mean industries across the board, restaurants, manufacturers, real estate companies, etc., filed business interruption claims. And by the way, if you haven't, I still highly recommend, if you sustained any form of financial loss through rents, to file a claim. You will likely get a denial letter like the rest of all the businesses that are out there. And every property insurance carrier will tell you that in order for there to be a property loss, a property claim, there has to be property damage. Well, COVID-19, the hot topic out there, they're making the case that there's no property damage. So they're going to deny claims based on that. They will even take it a step further and tell you that the typical ISO property form will always include a virus bacteria exclusion on it. So most every property policy out there, not all, but most every property policy out there is declining any form of business interruption or loss of rents claim. I am still making recommendations to file a claim for the mere sake of we don't know what the government's going to do. We don't. And if they were to step in, I like to think that the first in line process will play out in the claim process, because I think the government is not going to know how to adjust business interruption and loss of rent claims. They're going to have to sub that to the insurance companies. So I know I went off on a tangent, but I just feel like right now it's a very hot topic. I think everybody's, concerned about what to do, what's going on. Brokerage firms and HR firms are putting together plenty of resources to help you with your property management companies, with your tenants, on what to do in the response of a COVID outbreak or a COVID case at your facility. Of course, Vinny's going to share my information. If anybody wants any additional resources, I'm happy to provide those.
Oh, totally. And we're going to do it at the end also. How can people reach you? Please, tell us.
Absolutely. So you can reach me at my cell phone, 713-591-9512, or you can email me at K as in Kyle, Schielack, SCHIELACK, at Higginbotham, HIGGINBOTHAM.net, NET. So K Schielack at Higginbotham.net.
Surely, and we'll make them in the show notes also, guys. Please look in the show notes. You will have that contact to reach Kyle. He's just done. I just want to give special, recommendation and everything, because I remember I used to pay $1 million for my properties where they were individually, insured with another carrier. And when Kyle came into my life, he made the smoothest transition. He sat down with us, the business plan, and saved me at least, I would say, $300,000 coming to my mind. That's a 30%, reduction. when you do the master policy. So I really owe a lot to you. Thank you, Kyle, and you've been very, very responsive. You've been very, very upfront. And I really appreciate all those things, because as an owner of multifamily, of lots of deals, it's very, very important to know that the loan brokerage, company is on your side. And you always went and got the best of the best rates. That I can say that also, because, I've worked with you and interacted with you. So I appreciate that. Yeah. So that's the property policy. What's the next policy, would you say? Should we talk
I would say before we go on to the liability portion, terrorism is typically, I'm sorry, I'm just adjusting my screen.
Okay.
Terrorism is typically required by many lenders, specifically Fannie Mae, which many multifamily owners and investors deal with.
Yeah.
Terrorism, I will tell you, although it seems very inexpensive, since the creation of terrorism, call it 9/11, which was the creation of terrorism coverage being required by brokers on pretty much every policy at every year at renewal. There has yet to be a claim filed, because the federal government has to determine whether it's a terroristic attack or not. And it's the federal government's policy. So it's kind of I'm not a big fan of terrorism coverage, just pointing that out. But to move on to liability, and what I believe is actually more important than your property coverage, and I point that out specifically because I think you can always put a value on your property, what exposure you could lose if your property was a total loss, but you'll never be able to determine how much you're going to be sued for. And so when we're talking about general liability, we're specifically talking about third-party lawsuits for bodily injury or property damage. You've harmed somebody, or you've harmed somebody's property. They've either slipped and fall, they've drowned in a pool, a tree branch broke and hit one of the tenant's cars, or a guest car, etc. All general liability. Even further, and even a more hot topic in a very hardening market, is sexual abuse, molestation, and assault and battery. Those are two separate claims, but both of them are being addressed through exclusions now on policy. So I tell you, one of the key things to look at before you buy into general liability policy is ensuring that there's no exclusion or sublimit for sexual abuse and molestation and or assault and battery. The reason why you are starting to see those is because those are the reasons why there are massive claims and catastrophes going on the liability side. A great example is and I hate to bring up past disasters, but it had a direct impact on the liability market, and that was the Las Vegas massacre. When you look at a $600 million claim that's been paid out, which it was fully insured, that penetrates a lot of limits for all of the carriers that are involved in that scenario. So that is one of many different areas that have a direct impact on the liability market. Another one are these auto losses that are happening throughout the country. I mean, you see the billboards throughout the Gulf Coast, the Texas Hammer. If any truckers get in an accident, auto premiums are going through the roof. And I always like to point out auto when it comes to multifamily, because I think a lot of owners, investors, property managers, they don't believe because they own an auto that they have any exposure. So I go back to my original statement 10 minutes ago. You do have a non-owned auto liability exposure at all times. If somebody is ever driving on behalf of your LLC, your apartment complex, your property management company, whatever you have, that is exposure on the road. And in the event, call it a hydroplane, something very simple, gets in an accident, harms someone else, and there's a lawsuit, you will likely be sued as the LLC as well. So that non-owned protects both the employee or the person that's driving on your behalf as excess limits to their personal, and it also protects the entity. So I always like to make sure I point out hired and non-owned auto liability. Moving on, again, workers' compensation. I fully believe in workers' compensation. I mean, there's two main parts to workers' comp. And since I know that we're dealing with more than just the state of Texas on this podcast, part one is workers' compensation. That covers the employee's injuries. Typically, it's unlimited medical for life. It typically provides disability income, some death benefits in many states. Part B of the workers' comp policy, and what I would say is very important to the employer, is employer's liability. What that covers is the gross negligence of the employer in the event of one of their employees getting hurt. And I like to give the example, two examples. One, the tires on the truck that y'all own, that your guys are driving, the tires need to be replaced. They let you know, whether it's in writing or it's verbal. In the event you don't replace them, they get in an accident, they will sue you as the employer because they notified you and now you're grossly negligent. Another great one is the maintenance team. They may report to you that the ladders need to be replaced. Unfortunately, ladders are something that we don't always think about. They've notified you, whether it's verbal or in writing. They get in an accident, they get hurt. Of course, Part A, workers' comp, will cover their injuries, but then they are going to probably likely sue you, and that's where employer's liability kicks in. And you have, $1 million limits or the standard workers' comp on Part B of employer's liability. So I always highly recommend that every employer cover workers' compensation. If you are in Texas and you choose to be a non-subscriber, you will lose all your common law defenses. So you won't be able to sit in front of the courts and say that the employee assumed the duties of the job. You can't say that two employees were the reason of fault for the injuries. You basically are just sitting there and allowing the courts to determine how bad the penalty is going to be. Workers' compensation. And then again, excess liability, something that may be required by your lenders, but typically not to the limits that most of the multifamily industry and even commercial real estate industry is purchasing. 10 years ago, I would say that $5 million of liability limits for excess was the typical standard. And remember, all that does is sits on top of your general liability, which is a $1 million per occurrence limit, your auto liability, which is a $1 million per occurrence limit, and then your employer's liability under workers' comp, which is your $1 million limit. So any time you get sued in any one of those cases, you're only going to have a $1 million limit.
Right.
Buying an excess will extend that. So $5 million used to be the old standard. Today, we see 10, 20, and 25 million as pretty much the standard in the multifamily industry.
Wow. And then also, of course, the premium, of course, goes higher if the deductible is lower, right?
Correct.
Yeah. So you're
correct. So on the property, you can adjust that any way you want. On the liability, there really is only one deductible that applies there, and it's your per occurrence claim. So anytime you have a lawsuit or multiple lawsuits in one occurrence, there will either be a $0, $2,500, or $5,000 claim, typically a deductible attached to it. So if you want to make a significant improvement on your general liability premiums, I would highly suggest taking on a $25,000 deductible, which basically means you're retaining the attorneys. That's what you're retaining in the event that you're sued.
Sure. How about also, I know we always have had umbrella policy, right? And we do it for each asset. Can you kind of put some light on that? Yeah.
Yes. Okay. So let me back up. I continue to call it excess liability. The old term is umbrella, and I think most insurance buyers would still like to use the term umbrella. The reason why I've gone with the industry and changing the term from umbrella to excess liability is because umbrella used to, it would cover things that maybe necessarily the general liability wouldn't cover. An excess liability, which is pretty much the standard in the industry today, just is that. It follows form with what's underneath that policy. So the general liability policy covers it. The excess or umbrella would cover it as well. Now, I will say, you mentioned at each location. Great point. So when you are packaging an entire portfolio together, what the essential goal is you're trying to maximize the amount of values in the marketplace to give you lower cost, which it will work. However, in the event of liability, you're now sharing however many assets you have under the portfolio. Let's just say you have 20 assets. Well, now they're sharing a $1 million general liability policy and a $5, $10, $20 million umbrella. So that's very different than just one location having those same limits. So I always want to point out that you want a per location aggregate. I know that's legal terms, but per location aggregate is just the fancy term to give you a one general liability and umbrella, but it's for each individual location. It's just one big policy. It's just dedicated limits for every single property. Always, always, always want to have per location aggregates when packaging multiple properties together. And Vinny, I got to go back to what you said earlier. Most folks want to know, does packaging a portfolio policy actually work? And how many does it have to package? Yeah. And I will say most always it will work, unless there are catastrophe losses that are on one or a few properties that may have a major impact on the portfolio. Most of the time you will have credits that are gifted to you for the amount of total insured value you're purchasing. Yeah. So the more total insured value you can package within your portfolio, the better. Now, the one thing to always keep in mind is you have to have combinability. You have to have common interest, whether the common interest is through the ownership entity or the common interest is through the property manager. So the vast majority of the time when I look at a property, if it's on a master portfolio policy, it's either under the ownership portfolio or it's under a property management portfolio. Those two, the owners and the property managers, are the only two that have insurable interest per the insurance policies. So that's the only way you can technically package a policy. Now, you can join associations that do have group packaging, group products, but that is very slim, especially in today's marketplace.
Got it.
10 years ago, before Ike hit, before Katrina hit, back in 2003, before all of these major occurrences, it was very common to have massive programs, what we called programs, and it didn't matter what ownerships you had. It didn't matter what insurable interest was there. Everybody would just join in on these massive products. And what would happen is, in the event of a catastrophe like Katrina, there's not enough money in that policy to pay out claims. And so you had massive lawsuits from investors, owners, property managers of where are all these limits, who's going to come up with all of these monies that were lost through Katrina, Ike, or whatever catastrophe it was. So most of those big, massive programs have gone away, but the key to look at is if they're a shared limit program, and you will see that on any proposal you see. If anything shows shared limit, that means you're sharing insurance with other folks that you have no idea where they're at, how they're built, how they're maintained, or anything of that sort. So I know I can get off on a tangent, but there's just so much that goes into multifamily and trying to shave costs. And so, and obviously everyone wants to have the lowest amount of premium dollars coming for their protection. So just different areas to be thinking about, to be mindful of. I've looked through all of my notes here, Vinny. I've checked off all of the main points as far as negotiations when brokers are negotiating behind the scenes. But if there's any other questions you have, I'm happy to address those.
Yeah, sure. I would like to say, also when a claim comes, I've been very, very fortunate that your team members, everybody has taken upon quickly. And that's a big part. I mean, it's one thing to pay premium. It's another thing to get the service. And I think I kind of I shouldn't have gotten a public adjuster. That was, my hands got tied when I had that fire in Atlanta property. And that kind of took a drawn out process, and you could not work on my behalf, actually, or something. So share with that so that our audience don't make that mistake. Yeah.
Great. And great point. So in the event you have a claim, whether it's catastrophe or if it's just a fire, catastrophe is the one I like to bring up. And when I say catastrophe, I mean any major catastrophe that happens. You have what we tag storm chasers. And all that is they're just public adjusters, and they're looking for work. So when Hurricane, Harvey swung through Texas, the storm chasers from all over the country were coming in, and they're saying, for a percentage of the loss, we will go fight on your behalf. And everything that is stated, it sounds great to the buyer. But at the end of the day, what you do is you lose control of your claim. Now it is in public adjuster's hands. And I will tell you, they will take anywhere from 5 to 15 to 20% of the loss, depending upon what the negotiated price was. I would actually advise for a public adjuster in the event that your broker does not have a true claims department. And when I mean true claims department, I'm not talking about staff that sits there and keeps you up to date on where your claim stands and keeps the carrier up to date on where the documentation is coming from you. No, I'm talking about former claim adjusters that were in the field that have now become a part of your insurance brokerage team. And those folks typically know, a claim adjuster knows the policy better than an underwriter does. I know that sounds crazy, but if you think about it, one who's out there adjusting claims on a regular basis based on the policy form would probably likely know it better than one who is just placing coverage on a regular basis. So a simple claim example, and I like to point it out, Hurricane Harvey, just because it was so catastrophic for the Gulf Coast. When a major storm is coming on, and you know that you have a catastrophe coming, whether that's fire, whether that is flood, windstorm, or anything, if you know that there's a loss that's coming your way, tsunamis, coming across the world, it's become a hot topic lately as well. But anytime you have time to plan in advance, what you want to do is take control of your assets, have people reporting how the law, if there is a loss coming. As the rains were pouring in Houston, Texas, I had notified basically every client, notify me the second you feel that you are going to have a loss. In the event of a catastrophe, it's the first in line process. So when you have Hurricane Harvey come through the Corpus Christi area and put a windstorm event, go back in the Gulf Coast, and then come back over Houston, Harris County, and just dump a flood on the town, ultimately there's going to be millions of claims being filed. In fact, FEMA did not have enough claim adjusters on staff to field all of those claims that they came through. So I know certain insureds that were out there, it took 12 to 18 months before they had claim adjusters coming out on site. So I say all that to say, anytime you have planning of a time when you know a catastrophe is coming, be prepared to go ahead and turn in a claim. I think we had north of 30 claims filed by 8 a.m. the next morning. And all of those claims had adjustments opened up the following week, because as soon as you have a catastrophe come through, once it's cleared out, the adjustment process starts immediately, because they know how many claims are going to be coming in. So that's just kind of a precaution, anytime you can prepare for that. But once a claim comes in, there's so many different ways it's paid out, as far as how does the deductible work, how does everything. Sometimes carriers will go ahead and pay the claim and they will bill you the deductible, call it a fire, and you had a $10,000 all other perils deductible. So you have a fire, burns down one of the buildings. Some carriers will likely go ahead and replace the facility and just bill you for the deductible. Others will require you to go ahead and show proof of receipts until you hit the deductible, in which case they take that on. But ultimately, the main thing you always want to know, and if you've never experienced a claim, this is good to know. When you have replacement cost coverage, now remember, there's two types of coverage. There's replacement cost, which is always required by lenders, and then there's actual cash value, which is just replacement cost minus depreciation. Okay? So in the event of a loss, the way that they're going to pay a claim out is the adjuster, the contractor, they're all going to come to the agreement on the price. They're going to go ahead and pay the undisputed amount, which is just the actual cash value. And then in order to get the full replacement, you have to actually replace the property and then turn in the receipts and get reimbursed for the additional amount. I just always like to point that out, because I think first-time claim experience, folks don't realize that you don't get the entire replacement cost until you've replaced the property.
So true, so true, so true. No, that's so great.
Did I leave anything out on that, Vinny?
You have given so many gold nuggets. I'm so happy, that you joined. Kyle, it's been such a pleasure to know you for many, many years. And let me ask you a question, like my students in the academy, they are looking at a property, right? And if they want to get insurance quote from you, your team, what should they do? And what information would you need? And is it a long process? We don't want to bog you down with a lot of deals that may not pan out, right? So that way, could you give us some idea how we could do that, Yeah.
Yes, sir. Hang on.
Okay, no problem.
There we go. I'm good now.
Yeah.
Okay, I'm sorry, Benny.
No. This was regarding when we are.
Oh, okay. Yes, the statement of values. Yes, sir.
Yeah.
Yes, sir. Okay, so a typical process for an insurance broker, especially our team, underwriters, by the way, the more time they have, the better. They always love more time, just because, for many reasons that we can go into another time. Typical turnaround is anywhere between 60 and 90 days. That's what time the underwriters like to model model is just a fancy term where they put in all of the details of every property, and that's how they model out based on historical losses what your premium rate would be. The standard process is a statement of values. If you have property insurance in place right now, you know what I'm talking about. If you don't, it's just a simple Excel spreadsheet that gives the basic details of the property, i.e. the age of construction, the square footage, the type of wiring, the type of roof, the type of HVAC, the type of plumbing, and the updates for those four. And by updates, I mean technically full replacement. I think a lot of folks think that, well, I updated my roof, I covered all the patches. That was done last year. We need to have that updated. Well, no. Underwriters don't see it that way. For wind coverage, they see it as they're insuring the roof. So the replacement of the roof is the only date that they will go. But again, back to the statement of values, that's where you also determine how much replacement costs you have for the buildings, how much personal property you have at the facility, how much loss of rent that we just discussed earlier that you want to have included. It also would go into basically the number of doors, so you can rate out your general liability, the number of swimming pools, all of those details, all in one big Excel spreadsheet. And I'll tell you, although it looks overwhelming in the initial phase, after you've seen that spreadsheet and worked through it one time, it just becomes the normal standard. It's the same spreadsheet that's used in the entire property marketplace. They may look slightly different, but they're asking the exact same questions. In addition to that, most general liability carriers will have some form of supplemental application, which just kind of determines your safety precautions at the facility, specifically with regards to pools, if you have pools or playgrounds or anything that might have extra exposure than just vacant land or just grassy land. Outside of that, loss runs are always the most important piece of the entire process. And the reason why I point that out is because you cannot get a proposal from any insurance company without 5 years hard copy loss runs. And while 10 years ago, you could just sign a letter that says, I'm not aware of any, that today's market does not work. You have to actually have hard copy proof of all 5 past years property and liability claims reported on there. And they underwrite based on that and will not begin underwriting in most cases until they have loss runs. And the one thing I'll point out in addition to that is, in the event that you are acquiring a property, this can be the one thing that can hold your closing up, because insurance, again, still needs time to underwrite. And if the last thing that they have documented over to you as the buyer is the loss runs, you may be held up. You may have to delay closing solely because you didn't have enough loss run time to get to the carriers to underwrite. So I always like to point out, work with your broker, and I'm happy to share my information as well. Create a simple one-pager with everything that you need from the buyer from an insurance perspective and include it in your offer. Go ahead and attach that and make sure that the 5-year hard copy loss runs are included in that. That way, it's in writing that they know that they are responsible for getting this to you. From a seller's perspective, I will tell you, you are always likely to have a great experience with your buyer if you can provide documentation, especially for insurance, because again, insurance seems to hold up closings more times than not, as far as the reason for delay. So if you can help them smooth that whole entire process out by getting your broker to get loss runs in a timely manner, that will always work to your benefit in a closing.
Excellent. Oh my gosh, you're a bundle of so much good information, Kyle. Oh my gosh.
Thank you, Vinney.
I think everybody listening and watching us are going to feel so excited to learn all these things. You dropped so many great ideas, points. I really respect you for that. And thank you for, taking the time out of your busy schedule and coming on the show. Let me again say that, we'll put in the show notes how to reach Kyle. Kyle has been a great friend of mine and done so well. If some people are looking into a 48 units or 96 units, what information do they need to give you to get a rough quote of the insurance for underwriting, for example?
Okay. In the event, I would shoot me an email and I will send you a spreadsheet.
Okay.
And the spreadsheet is very simple. There is probably 20 columns that you would need to complete on each property. Again, packaging of properties is always the best. But that spreadsheet pretty much identifies anything and everything that's included in the proposal process.
I see. I see. Would the year of the property, number of buildings, and you
Yes,
look
sir.
from the map, Google map, can you give like rough estimate, or no, that's not possible for the insurance quote? Just
Yeah.
for
So,
underwriting, because see, we don't want to take away your time or your team's time. We underwrite so many deals, right? So
absolutely.
I'm just thinking, yeah, yeah.
Okay. Yeah. So in the event, square footage is always most important, and then identifying what your replacement cost per foot is. Okay. So those multiplied together will give you your insurable value. So for example, in today's market, call it multifamily in the 60 to 90s construction range. I would say they're going from $80 to $100 a foot is what the construction industry says is per foot replacement cost. Okay. So basically, once you identify how much that is, maybe it's your lender that's telling you what your limit should be, but it's basically your square footage times how much replacement cost per foot you want. That'll give you your building limits. Of course, most apartment complexes have minimal business personal property, but you definitely want to identify if you have any personal property that the LLC or the LP owns, that you want to make sure that's included. Again, loss of rent is going to go toward what your rents look like. So if you have, call it the last 12 months rent, look at an average rent for 12 months, and that's what's going to be your loss of rent that you want to have coverage. You're definitely going to want to identify the number of buildings. You're going to want to identify the number of stories of each building. You're going to want to identify the number of units. You're going to want to identify the number of units per building. Again, I know I'm going a little bit further and a little bit more deep and extreme, but I will tell you, if I look at a property policy and I see a named storm deductible of 5% per total insured value, to me that screams, oh, that's a nightmare for the owners. What that means is if a hurricane or a named storm were to come in, you're paying 5% of the entire complex, whether it's 10 buildings, one building, you're paying 5% of the entire complex when maybe only one building was affected by the named storm. So the only way you can get a deductible to be per building for named storm is you have to identify each building's square footage, each building's unit count. And if you can go through the extra steps of that, the insurance companies will likely not charge you anything, and they will separate your percentage deductible per building, which is most advantageous for all buyers of insurance. So true, Kyle. And you have done it for me. So I totally see where you're coming from. No, how can great people reach you and your team? Say that again. Yeah. Okay. Thank you. So I always like to give my cell just so that my potential future clients understand that I am reachable. I like to be very in sync with my clients, whether it's text message, email, phone call, whatever it may be. You can call me at 713-591-9512, or you can email me at kschielack@higginbotham.net, KSCHIELACK@HIGGINBOTHAM.net. You can also find me on LinkedIn. You can also find me on Facebook. I'm available in all of those sorts, but I will say that I'm on LinkedIn more than I am any other social media. I just like to see all the articles and everything that's going on. My passion in life has been the commercial real estate industry. The only reason when I was in commercial lending was to service the real estate industry. So any way I could have gotten in and gotten involved some way, networked through the real estate industry, I was excited insurance was the way I got there. Love it, love it, love it. Thank you again, Kyle. Appreciate you, buddy. And thank you so much, Vinny. I'm very, very happy to be here. Surely. All the guys, hey, if you have really liked what you saw today or heard from our, interview right now with Kyle, if you'd like to hear more about real estate news, all the different professionals that can make your job easy and make you understand the different concepts, please like this episode, comment, share, subscribe,
give it to your friends and so forth like that, that they can also really learn a lot out of it, a lot out of it, you know. That's okay. That's all right. I know we are in the COVID section. So again, you can reach out to us if you want to reach me and my team. That will be vinneychopra.com, VINNEY, Vinney, CHOPRA, Chopra.com/success call, success strategy call. And then if you would like to invest with us, visit us at vinneychopra.com/invest. Thank you so much, Kyle. Thank you so much. I'll talk to you. Yeah, sure. Thanks so much. Again, guys, it's such a pleasure that you are tuning us every week, and look for the next episode. Remember don't forget to like, subscribe, comment, and share this episode with the people that you think could really benefit. I think Kyle used so many great terms and so many great nuggets he dropped in this interview. It can be really totally can change any owner of apartment or any commercial building, or as such, why insurance is so important and what kind of insurance is. And Kyle covered every spectrum of it. So thank you, Kyle. Really appreciate that, buddy.
Thank you.
Take care, and we'll see you again. Take care.
Yes, sir.
Bye-bye. Bye-bye.
Bye-bye.
Be sure to listen to Mr. Smiles next week with more golden nuggets and top-notch coaching tips. You can reach him by going to vinneychopra.com or texting the word syndication to 474747. Be sure to like, comment, and share to show everyone how Mr. Smiles has brought your apartment syndication business to the next level.